So what is the macroeconomic outlook for 2026? So in a few words, stay invested among uncertainty, slowdown, and instability. Thank you for being in the podcast. My name is Peggy van der Plage. So last week I attended the 2026 Macroeconomic Outlook organized by 100 Women in Finance and sponsored by Scotiabank. So the panelists were Nan Chen. So Nan is a director, global multi-strategy at Omers. Lau, she's SVP and Chief Investment Officer at Brompton Global. And Rebekah Young was VP and Head of Inclusion and Resilience Economics at Scotiabank. So it's a mouthful, but they were lovely ladies and extremely insightful. So the goal of the panel was to help the audience navigate the 2026 macro environment with more clarity, and God knows that we need that. And the discussion was like super dynamic, very insightful. I really loved it. And I also loved the opportunity to browse the Scotia Fine Arts collection, which happened to be on the same floor than the event. So here are some of my takeaways. So the number one takeaway is about uncertainty. So uncertainty, that's not a phase. It's really the main backdrop. And if you look at global growth for 2025, it was expected to arrive at 3.2%, and it actually arrived exactly at 3.2%. But the path there was a very wild ride, as I'm sure you remember very well. So Rebekah put it best: uncertainty is now the only certainty. So the news cycle has become, too big, too fast, too loud. Crazy things are happening simultaneously. The Fed, Venezuela, Iran. It's difficult to keep track. And nonetheless, the outlook is what we would say uncomfortably optimistic. Some people lean more towards the optimistic, others lean more towards the uncomfortable, but this is uncomfortably optimistic. And as Laura mentioned, uncertainty, there is nothing new. Everywhere something happens, but it's still, I would say, even more the case right now. So number two, no recession. But nonetheless, everything feels fragile. And so you'll see job markets cooling, wages are cooling, tariff-exposed industries are suffering. Households are increasingly split between the one who have assets, the one who don't have assets. So the environment we're being here can actually support a slowdown without tipping into recession, especially with the fiscal policy expected to step up in the second part of 2026. And the US still in the Goldilocks rate cutting scenario. But at the same time, resilience is really eroding. Modeling for economists is getting harder because the data quality is weaker. At the same time, retaliation risk, tariff, geopolitical are very real. So, everything make it quite fragile. At the same time, the price to earnings ratios are likely to remain elevated. So you're really seeing this disconnect between markets and real economy, particularly on the labor side. And that raises uncomfortable questions about social cohesion, about long-term stability. So again, we're not talking recession, we're talking slowdown, but still you're on the edge of the knife. The number three takeaway, and it's something you probably heard in the past, is it's really about distinguishing the signal from the noise. So today the markets remain cautiously bullish for 2026. The momentum is still there. The buy on the dip mindset is still alive and well. So what does it mean? Well, stay calm, diversify by asset class, by geography, by company size, small cap, large cap, but be very careful with thematic crowding. So being over invested in one area, usually the Magnificent Seven. So since 2025, strong runs actually have come from Europe, from Asia, from Canada, not just the US anymore. So opportunities are way broader now than the headlines suggest. You know, it's always about the American exceptionalism, but there are many other geographies that are interesting. You still need to be invested. That's very important. You cannot just stay on the sidelines. You need to be in the game. So takeaway number 4, AI. We need to talk about AI. So AI, it is not a bubble yet, but it is really about discipline. So the fact that we're not in a bubble yet is something that, you know, was widely discussed. And I'm sure you cannot open a newspaper without saying, are we in a bubble? We're in a bubble, we're not in a bubble. But from the perspective of the panel, we're not in an AI bubble yet, but this is only the first or second inning of a very long game, which means they will have valuation corrections along the way. So again, we're looking at a long-term trend, which might go up in the future with dips along the way. So keep that in mind. And this is probably the year to diversify away from the Magnificent Seven, back to what I was saying with being careful with thematic crowding. So the real beneficiaries of AI now are not just, again, the AI developers, you're again, Seven Magnificent and so forth, because thanks to the modernization, the great modernization enabled by AI adopters will actually be the largest beneficiaries in the long term. So retailers like Walmart, financial institutions, any companies that convert AI into margin expansion. Tech companies that tend to be early adopters also benefit from this modernization. They have already started, as I'm sure you've seen, slowing down the hiring of developers, for example, and they are also beneficiary of AI adoption and not AI development. When you look at AI, it's almost now like a maintenance capex, because if you don't invest, you don't survive. And nonetheless, there is an important warning here when it comes to AI, is that if AI fails to deliver the productivity gains, while actually the job market slows down, the macro consequences could be very severe. So that's something to see as well. And another thing, the last but not least, takeaway is on Canada. Canada is down, but it's not out. So Canada is actually becoming more business friendly thanks to the new Prime Minister, Carney. The leadership mindset we're seeing now in the government is really shaped by ease, global capital markets experience. So foreign investors are paying attention again. Pension funds, platforms like Brookfield will follow these foreign investors and allocate more capital to Canada. And one of the questions is always on the mind of Canadians is, how does Canada compete with the most competitive country in the world, that is its neighbor? Well, it must invest in what it has, resources, energy, minerals, or risk literally hollowing the economy altogether. So that said, Canada needs this strategy to work, even if we're unlikely to see any results before 2027. Very, very important for Canada to see that strategy to pan out. So bottom line, think long term. Anchor portfolio in secular trends. Mindfully, again, be careful of overcrowding. Diversify relentlessly, stay invested. You cannot afford to be on the sideline. And above all, judgment beats prediction in 2026. So uncomfortable optimism may be the most honest stance we have right now when it comes to 2026 economic outlook. So thank you for being here, and let's talk to you next week.